the spike in data center growth has been impossible to ignore. Companies like NVIDIA and AMD have been profiting massively off of this. We've seen a whole bunch of growth, but we have not seen the underlying infrastructure grow enough to support it. And by that, I am talking about electricity. So this article right here shows the projected peak demand and electricity demand going forward into 2050. We can see the course that we've been on. It's been relatively flat. We've had very, very even electricity demand over the last 20 years, and now it is starting to tilt up as data centers are expanding everywhere. Great point, Hokage. Plab, ASML, GMAB, HCA, Rocking, PayPal too. I've been really happy about those companies for sure, man. For sure. It's good to see. Okay, so energy demand on the rise. There is also an executive order by President Trump deploying advanced nuclear reactor technologies for national security. So in his executive order, he says the federal government must utilize its full authority to accelerate and secure responsible development, demonstration, deployment, and export of United States designed advanced nuclear technologies. So we have huge needs for electricity. We have the president of the United States issuing an executive order saying we need to accelerate nuclear power. On top of that, projections for nuclear power is staggering. So they're saying by 2050, the U.S. has a target to quadruple U.S. nuclear capacity. So the United States is on a really, really strong trajectory as far as increasing electricity in general, but also nuclear power. So I decided, I probably have waited too long. Honestly, I should have been looking to invest in nuclear sooner, but hey, you can't look at everything. We've been looking at a lot of companies on this series. This is my public YouTube portfolio series where I invest in a different company every week. And we have, I want to say 34 holdings now, currently beating the S&P 500. So I'm very happy about that so far this year. And we're looking to keep going strong. And nuclear, I think, is a great way to do that. So I decided I'm going to find a company that is in the nuclear industry, that is at least adjacent to nuclear, and find one that is still undervalued, because it's not easy. A lot of companies are incredibly overvalued. Just to name a few, I looked through so many companies, went through a shallow analysis on many, and they were all just insanely overvalued. BWX Technologies, Cameco Corporation, Duke Energy, Dominion, Intergy, Energy Fuels, UU. This is the one that's been popping off a lot lately. If I look at the last year, it's up 233%. It's just so high, way too high of a price for me. Uranium Energy Corp, too high. Your Energy, too high. After going through so many companies, I finally stumbled across one that looks to be undervalued still. And this is a tough one to analyze because it's not profitable yet. Net income negative $62 million, market cap of $640 million, revenue of $44 million. So it's relatively small. It is unprofitable, but it is in its early growth stages. And so in this video, I'm looking to use a price to sales valuation method that I'm excited to go over. I did a lot of good research on what their projected revenues are going to be. And when it comes to comparing price to sales now to price to sales in the future, you gotta have good projections. I mean, that's everything. There's going to be two major factors that I'm going over in this video. We're going to be looking at revenue projections and price to sales ratio compression. So essentially, if I know the price to sales ratio now, and I have an idea of what the revenue is going to be in 5 years, and then I can have an estimate for what their price to sales ratio, like a reasonable range of price to sales ratios, then I can also come up with a reasonable range of share prices. And then I can calculate, okay, if that is the share price in 5 years, what is my annual return if I decide to hold it for all 5 of those years? So that is essentially the strategy. Another thing that I've recently added to my stock due diligence repertoire is Charles Schwab has some really, really good reports. Now, I have a brokerage account on Charles Schwab, so I didn't realize I had access to their research tab. I had never really looked through it very much, but now I'm really excited to share some of this. So this is the Charles Schwab LSEG Stock Reports Plus. They have several different analysts that do reports. This is one of them. So when I scroll down, the main thing that I'm taking away from this one is they give revenue projections for the next couple years. Normally, I get my revenue projections off of stockanalysis.com, but there's just not a lot of information here, unfortunately. They've only have one analyst showing strong buy, one of one. There's not a lot of revenue projections that I want to put much stock in because, like I said, it's only a handful of analysts. I really wanted to get multiple opinions here. So, for instance, they're showing on Stock Analysis, they're showing $73 million in fiscal year 2025. I think that's a bit of an overestimate after I'm looking at some of these other reports. So, for instance, on this one, and this matches some of the other research that I did where I'm looking at their contracts of uranium to deliver in pounds and then comparing that to the current price of uranium and a range of prices. It really is more in line with what this report is projecting for at least the next year. So let's scroll down a bit. So here is the revenue estimates. So from 2024 to 2025, most estimates are saying that they are going to drop a little bit in revenue from 58 in 2024 down to 44. But then in 2026, the range of revenue. So actually, let me restate that. So in 2025, the lower end is 45 million. The average is 52 million. So they are projected to drop a little bit this year at the end of the year, but an 81% increase going into 2026 from 2025. And this is in line with their contracts that they have that are already set in stone for how much uranium they're going to be selling going forward. So I'm also excited to showcase that a little bit. Hokage says electricity or energy is like shovels for the gold rush. So this is like the AI rush. Exactly right, man. Exactly right. Okay. So where were we? All right. Oh, another really interesting resource that I found on Charles Schwab is they have this Vickers insider trading. And so on all the companies that I looked into, I checked this report on every single one. And on every single one, when I look at the insider activity, it is all sell, sell, sell in this year, in the year 2025. It's all selling. And when I look at Encore Energy Corporation, stock ticker EU, I'm seeing almost 100% buying. So at the very beginning of the year, people sold at around the $3.20 to $3.55 range. But since then, it's been all buys, and we've got some option buys, and we've also got direct buys like on the open market. And when we have open market, like when people are just buying in the stock market, insiders, that is a really, really, really good sign. A lot of times you'll see people getting access to stock options where they're just awarded shares for a price of zero. And so in the other companies I looked at, that was almost 100% of the buying activity was just stock options, stock-based compensation type transactions. So really good insider buying, which I love to see. So, okay. Next thing I want to look at, let's look at my free stock screener. So this is all the companies in the industry of uranium. And here is EU right here. So I've got this filtered here by price to sales ratio. So EU has a price to sales ratio of 14. Actually, let's filter this by revenue. So biggest revenues on top, smallest revenues on bottom. So revenue growth over the next 5 years, we're seeing a lot of these companies have really, really high revenue growth. And EU has a price to sales ratio roughly in the middle of the pack. So, and they're not even, so in general, as a company's revenue goes up, the price to sales ratio tends to compress. But what I'm seeing here is I'm seeing plenty of companies that have more revenue than EU, but they also have a higher price to sales ratio. So that gives me some hope that EU might actually end up with a higher price to sales ratio in 5 years if they continue to have high growth projections going forward. If they meet their current growth projections and they have more growth projections in the future, then they can continue to have a high price to sales ratio. So that is also encouraging to see. Most likely, I always assume the worst case scenario that they will have some price to sales compression as they gain more revenue, but there's a wide range of price to sales ratios in this industry. So currently at 14. Now, in order to determine what their future revenue will be, like I said, I looked a little bit at the projections, but also I decided to pull up their contracts, their future contracts. So this is for December 31st, 2024. They show how many pounds of uranium they have a contract to deliver, and then how many optional pounds. So I went back all the way to 2022, and I compiled all of their contract data right here so I could see how it's changing over time. So in in December of 2022, they had this was their forecast. So they had in like concrete, in contracts to deliver 500,000 pounds in 2023, 600, 700, 700, and 650. And then when we go to the year 2023, we look across, we can see 2024 actually bumped up to 720. 2025 was the same. 2026 was the same. 2027 was the same. And then now they have 200,000 pounds in contracts for 2028. But then when I go to 2024, we start to see some major changes. This is where demand is really starting to increase for uranium. So 2028, that's a 4 times increase. Now it is up to 800,000 pounds. 2027 also had a solid increase. 2026 had a solid increase, and 2024, it appears to be a decrease. But when I actually look at, what am I looking at here? Sorry, 2025 appears to be a decrease, but when I look at their optional, so here they split out the firm deliveries and the optional deliveries. So I'm not really sure. In total, it's 730. I'm not exactly sure how they counted it on some of these other years. So maybe they took a 20,000 pound hit, but most of these years are increasing. And then now in their most recent quarterly report, I'm seeing an increase across the board, except for 2027. So 825 to 900, 850 to 850, 800 increases by 25% to 1,000. And in 2029, they have, and I skipped over this one. So yeah, we can see in 2029, 1,300,000 pounds of contracted deliveries, and now it's up to 1,500,000. And then in their most recent report, they just say thereafter. They don't give, so this 3,700, this isn't all necessarily in 1 year, but this is contracted deliveries beyond 2029. So I mean, so what I'm doing to gauge their next 5 years of revenue is I'm taking this delivery outline right here as a base case. I'm assuming this is my bare minimum because these are the contractual deliveries that they have on the books. And then I am multiplying it by a range of uranium spot prices. So when I go to, let's see, I pulled up a uranium price chart. Okay, so it's currently at 80. It has been as high as 105 recently. The price dropped off, and now it's been on the rise again. When I go to a uranium price forecast, let's see what the analyst forecast for the industry. So for 2025 through 2026, analysts vary. Of course, the most bullish forecast put it at $135 per pound, whereas the most conservative are putting it between 90 and 100. So the range of spot price for uranium is anywhere between 90 to 135. Now, just because those are the most conservative analysts doesn't mean that they can't be wrong. They could still drop lower. So I decided for my lower bound, I decided to put in 80, which is the current spot price. I decided a middle ground of 100 and 135 for the high. And based on their minimum contractual deliveries for 2029, I see an absolute, in my mind, the absolute lowest amount, because they could add more contracts, they could have more optional deliveries that go through. I mean, there could be a lot of things that happen here that increase this revenue number. And so for me, I have $120 million as my base case revenue for 2029, 5 years out. So this is my spreadsheet right here that I made to do a price to sales ratio valuation. The way this spreadsheet works is I take their current shares outstanding. I take my projection for how much dilution they're going to have over the next 5 years, and we can look at that really quickly. Let me just get sidetracked here a little bit. So to see the dilution, I go to the financials page, income, scroll down a bit to their shares outstanding. So over the trailing 12 months, they have diluted their shares by 12%, and they have been trending down. So they dropped by 60%, and then 35, then 26, and then 12% dilution. So this dilution is most likely, if they continue to be successful and they make their contractual deliveries and their revenue continues to go up and they become profitable, they will have less need to dilute their shares. They will not need to issue as many shares. So I'm assuming 10% average over the next 5 years. They're already down to 12. So a 10% average for the next 5 years to me seems fair enough. We've got their current share price right here and their current sales. This is over the trailing 12 months. This is $45 million in sales. So the way this spreadsheet works is I take 3 different growth rates. So a 22% growth rate in revenue over the next 5 years gives me a revenue in 5 years from now of $120 million, which is this number right here. This is my base case, assuming they don't get any more contracts, assuming the spot price of uranium stays exactly where it is. It doesn't go up, even though all of the analysts believe it'll go up. So that's my base case. 22% revenue growth, 30% revenue gets me to 165, and 35% revenue growth gets me to 200. So if I look at this spread right here, the highest here I have if we do get to 135 uranium spot price, then we have a sales that year of 202 million. And again, that's assuming we don't get any more contracts between now and 2029, which, based on their past trend and the growing demand for uranium, which we've seen in the market, I find that to be incredibly unlikely. But I'm going to value this company based on what I think to be a very conservative outlook. So, if we just take 2028 for an example, in 2023, they had 200. And then in 2024, they had 800. And then in 2025, they had 1,000. I mean, these numbers are probably going to keep growing. In my mind, it's probable. So I find it incredibly conservative to use these sales growth rates given their minimum contractual obligations. The next step is to figure out a range of price to sales ratios that I think is reasonable. Now, we already looked at the industry. There's a huge range above and below 15, which is where they're at roughly. It's like 14 and change. So for the middle case, I put it at 15, and then I just decided to make a range of price to sales ratios, 20 to 10. Now, I saw price to sales ratios above 30. I think we saw price to sales ratios. We didn't see any below 10. So it's probably, if they're hitting their growth metrics, they're probably not going to drop back down below 10. And when I look at their history of price to sales ratios, this gives me another clue. If I go to their financials ratios, their price to sales ratio expands quite a bit in response to growth. So in 2022, they have a price to sales ratio of 60. That's because at that time, there is a high expectation for growth, which they did hit. And once they hit all that growth, the price to sales ratio shrinks because their sales goes way up. Their price goes up, but not as much as their sales. And you get a decreased price to sales ratio. Their sales go up, but their price doesn't go up as much. Yeah. No, vice versa. Sorry. And then, they have bad expectations going forward. They have, I'm actually looking at market cap. Sorry. It would help if I looked at the proper thing here. So from 2022 to 2023, huge growth in revenue. From 2023 to 2024, huge growth. And then over the 12 months, they've actually dropped off. And so what we see in their ratios is we see that ballooning of the price to sales ratio. And now as they're dropping in revenue, their price to sales ratio has dropped off. But now that we're seeing a higher forecast going forward in terms of their revenue growth, going from 10 to 14, we're seeing the price to sales ratio start to come back up. So with that in mind, the assumptions that I have in place are a price to sales ratio between 10 and 20, 5 years from now. Now, with all of that in mind, we've got our share count. This is how many shares I believe there will be in 5 years. That's assuming 10% dilution every year. We've got their total sales. We've got their price to sales ratio. With this, it's just an equation, and we can calculate a heat map of potential share prices. So if they have a higher price to sales ratio and they hit their upper echelon of revenue projections, then their share price will be roughly $13 per share in 5 years, which would represent a 30% return per year. And then we can see as the heat map goes cold, we get to the lower end of the spectrum. So let's say they hit their minimum contractual obligations. The price of uranium does not actually go up. It actually stays low, and their price to sales ratio also compresses. So 3 strikes. Now we're seeing a fair share price of $4, which would mean a return for me of 2.86% per year every year. So even in my worst case scenario, I'm still not losing money. In the vast majority of these scenarios, I am getting a 10+% return on my investment. So this one's pretty close. So if they have 30% revenue growth and they have the lowest price to sales ratio, then the stock price is going to be roughly 5. That represents a 10% growth per year. So what I'm looking for whenever I'm doing this price to sales analysis, I want to see a heat map where the vast majority of cases on the conservative end are more than 10% gain per year. And that's exactly what I'm seeing here with an upper gain of 30%. And this, to me, this isn't even a true upper echelon because we haven't accounted for any expansion of this target right here. So let's just say hypothetically by 2025, they're able to hit 2 million pounds. That could put their revenue at $270 million, which would be a revenue growth of, what was that, 40%? More than that. About 45%. Now my gain per year is 40% per year. So given their current trajectory, given their minimum contractual obligations, I feel like I'm saying that word weird, by the way. I mean, this company looks undervalued to me at the moment, which is, it's funny to say, most people, when they look at a company like Encore and they see, a price to sales ratio of negative, or a price to sales ratio of not applicable, earnings per share of negative net income, typically you're not thinking, okay, this is going to be a company that is going to qualify as a value company. But if you're looking at companies that are not yet profitable, you have to change your method of calculating valuation. Normally, I like to use a discounted future free cash flow method. In this case, I don't think they have any free cash flow, so I can't use that method of valuation. Now, one thing, I don't think they have positive. They have negative operating cash flow, so negative free cash flow. Now, one thing I do like about this company is they have cash and short-term investments. They have $38 million. When I go to their long-term debt, I see 0. So that is a positive in terms of taking some risk off the table. If this company was not profitable and then they also had a ton of debt and they also had a big interest expense every single year, then I would be a lot less likely to invest. But as we can see, their interest expense is only $1.48 million. Meanwhile, they have revenue, or sorry, they have cash on hand. My bad. They have quite a bit of cash on hand, $38 million. So in my mind, Encore, undervalued. I like it. I think a lot still has to go right. They have to reach profitability in the future, but based on a price to sales ratio, this company looks really good. Excuse me. So does anybody have any questions? And I should also point out, so on my usual method of valuing companies, I use typically discounted future free cash flow. I've only used this price to sales ratio with one other company to invest, and that was CoreWeave, which has done pretty well since I've invested in it. Let me just pull up my public YouTube portfolio really quick. Okay. Here's the public YouTube portfolio. We invest $100 roughly every single week. We are halfway to 10K, and once we get to 10K, we'll probably up the weekly investment maybe to $200. But here is the portfolio. We've got 34 different companies. Let's look at our performance really quick. If I can find it. For some reason, whenever I have my screen crunched like this, it's difficult to find. But anyway, CoreWeave, since we've invested, it is up 17.7%. So happy about that one. And CoreWeave was another situation where it just looked really, really strong in terms of price to sales ratio. But let's see. Okay, I'm looking for, I have the screen compressed. Sorry, bear with me, guys. I got to stretch this out so I can actually see view benchmarks. Okay, everybody can see this. You're not going to get to see my face for a second, but that is fine. Okay. So if we put it up against the SPY benchmark, we can see year to date that the YouTube portfolio is up 25.75%. S&P 500 is up 15.86. So we're beating Vanguard Total World. We're beating iShares Core Growth. We're beating the S&P 500. This valuation method has been very reliable for me since I've started using it. I've had really good success. And okay, Kajay, did you invest in Snow? I believe I did. Let's see, where is it though? I believe it's negative currently, which it is a good candidate for another look because whenever, yes, oh no, it's positive, my bad. Snowflake up 11%. I was thinking of Nice. Nice is, it's about even now. But yeah, Snow I really like. If we look at the companies here that I've invested the most in, so HIMS is up the most, but yeah, I've doubled down on Google. This was one that the discounted future free cash flow method showed was undervalued compared to the rest of the Magnificent Seven. I invested in Google initially. It continued down in price. I doubled down, and now it has since shot up quite a bit. That was really nice. Plab, we've doubled down on. PayPal we've doubled down on, and finally we're getting rewarded with PayPal. You know, PayPal was one where, man, it blows my mind that it is so cheap. And even still, even though it is up, PayPal is still undervalued. PayPal is such a strong company. Capital One, let's see, Canadian Natural Resources we doubled down on. It's looking really strong. But we've also doubled down on a few that have not been looking good so far. So Adobe was doubled down. It's looking okay. Lululemon we doubled down on ever since it dropped off a cliff. I believe the market overreacted to that drop. It's coming back to even. And let's see, we doubled down on Akame. This one has been slowly recovering since we've invested, and I haven't done an analysis on Akame in a while. Crocs, I love Crocs. I think this company is just so undervalued. Now, of course, question from Okaje. Question is when the bear market hits, which I expect anytime soon. Do you plan to keep adding to your existing positions or buy some new tickers? So it's a great question. Generally speaking, I don't try to time the market because in terms of like when there's going to be an overall crash. Now, I say that on one hand, and so what that really means is I never stop investing. I never sell out of my positions, but when it seems like there's a crash incoming, I will focus more on value in general. I'll look harder for companies that appear to be undervalued, and I'll look more at companies that are stable, that are less likely to crash as much during a recession or during a bear market. And then when the bear market hits, then I'll focus on buying the companies that drop the most. So to answer your question, it's a mixture of both. There are a lot of tickers on here that I will be adding to, and then there will be some new tickers as well. And I think next week I may do a video or a live stream on a company that I believe to be a really strong recession hedge or bear market hedge. So I think that would be a good thing to start touching on, because I don't know, Hokage, I don't know if you saw my most recent video, on my regular series. There are lots of indicators stacking up that a recession or a bear market is likely to come in the near future. There's just lots of indicators. So, okay, moving right along. Simply Good Foods, it's down so much. That's one that I need to look at again. I don't believe, let's just look at it right now. Let's look at it really quick. When we look at the forecasts, the analysts generally like it. The top analysts, I guess there's probably just one top analyst, otherwise they wouldn't all converge on 37. But the analysts generally like the stock. Most people are saying buy. And the revenue growth is pretty strong, at least for the average analyst. I mean, this is one that's a little bit of a mystery to me. And it fits into, I like the story, it's people are getting more and more, they're prioritizing health more and more, but I feel like people are still really valuing the kind of lazy solutions, convenient solutions, and Simply Good Foods is like, here is prepackaged healthy snacks. So it lets people keep their habit of snacking, but then also feel like they're going to be healthy. So I like that in general. So Simply Good Foods, yeah, when I look at, if I assume just a 6% revenue growth over the next 10 years and then inflation growth after that, I'm seeing 46% upside. So yeah, Simply Good Foods still looks pretty solid to me. I'll keep holding Simply Good Foods. Hokage, yes, I watched the new video. It's good content. Thank you very much, man. I appreciate it. That was a video that I worked pretty hard on. Pulled a lot of information for that video. So I'm glad you enjoyed it. For me, whenever I make a video, a lot of times it's something that I'm just curious on. I don't necessarily know the answer before I start the research, and then we see what we find as we research the topic and put together the video. And for that one, for some reason I kind of thought that there would be fewer indicators than the last time I looked at this topic, but there are actually more indicators, actually looking more and more likely that we're going to have a recession. When is it going to be? Or maybe not necessarily a recession, but if enough indicators stack up and then people think there's going to be a recession, then the stock market drops. And, who knows when that's going to be? It looks like it's going to happen though. Okay. Yeah. Simply Good Foods looks really good. Let's see what else. Hokage, do you have any companies that you are interested to look at together while we're live? We don't have a ton of time left, but if you had something you wanted to look at, man, I would be down to check it out with you. If we go back to our spreadsheet here. Let's see. Here's a company that I'm really tempted to look at doubling down on. Iridium, because it was one that I really thought looked great whenever I initially invested, and it has since it's just been not looking very good. Let's see here. Let's see what the analysis is. Oops. Iridium Communications. This company provides mobile voice and data communication services and products to businesses, the United States, and international governments. Mobile satellite communications. Okay. On the forecast, mixed on the analysts. Analysts are mixed. We've got 4 analysts saying buy, 1 analyst saying sell. As far as the revenue projections, we got a solid mix of revenue projections here. Let's paste it into the spreadsheet and see what we get. Based on, oops, this needs to be 0 right now. Looks like their average free cash flow margin is about 31. So we need to drop 5% off of this. And let's do a bear case for this. So if I look at 2% revenue growth every year forever, then the company is still 16% upside. Hokage says, I haven't had a chance to check. I've been adding to Iridium, ACN, and Simply for the short term. That way I bring my averages down. Very good. Yeah, for Iridium, I'm looking at it right now. What the average is about 5% revenue growth. So if we just go with the average analyst projections, 5% revenue growth, and then if we use a very conservative perpetual growth rate of 2, I'm seeing a 66% upside. In line with the lowest analysts are saying they're going to be losing revenue about 3%. So let's put -3. Oops, not there. Let's put -3 for the next 5 years. And then my projection drops to -7. So this company is about at its fair price if the most bearish analysts are correct. And for Iridium, I wonder if Charles Schwab has a good... Let me see if Charles Schwab has a good... what's the word I'm looking for? A good report on this company. That's actually taking a while to load. We can mess with that later. I'll have to check the Charles Schwab resource now for some of these companies. But yeah, Iridium looks really good. You also mentioned... earlier, I didn't mean timing the bear market. I mean when it happens. For your public portfolio, are you planning to double down, as in add more for the same set of tickers or expand the portfolio more? Okay, I see what you're saying. Sorry about that. Yeah, that is a fine question. We will most likely be doubling down quite a bit after it happens. Yes, because due diligence is already done. Now, I will say this. The due diligence is done, but... When you have a big market sell-off, a lot of times there will be new developments that come into play in the near future or concurrently with the bear market dropping off. A lot of times there are negative business outlooks associated with that. Businesses, like if the stock market is crashing and there's a perception that the economy is going to be worse, then businesses will change how they're preparing for future capital expenditures, future growth. It may actually change some of the businesses. So Arch Gamer, hey, how's it going? It's going well, man. I'm glad you could join us. We're here at the end of the stream. But I usually start the stream at 7:30 on Wednesdays. So next time, if you're able to come up around 7:30, you can see the beginning of the stream. We looked at nuclear power this time. My company of choice, just a quick recap for you, is Encore Energy Corp. I think it looks pretty undervalued given their contracts that they already have secured for future uranium deliveries. So that's the recap. This is the company I'm going to be buying this week on my public YouTube portfolio. But yeah, Hokage, for sure I'll be doubling down on a lot of companies, for sure. Nice. Arch Gamer says I'll have to pop in then. I hope you do. Yeah, Hokage, we will be 100% doubling down on a lot of the companies. And then, like I said, I think in a bear market, there will be lots of new opportunities as well. Lots of companies that I look at that I love. I think they have, really good balance sheets, strong forward revenue growth, no red flags. A lot of those companies will actually come down into a range where I can buy them safely. So that is one of the things that I'll be looking at in addition to doubling down, for sure. In addition to doubling down. Now, ideally, a lot of the companies that I've bought, I can't say for sure it's going to happen this way, but the companies that I buy, I try to focus on value. So in theory, they should go down less than the majority of the market. In theory, we'll see if that pans out. It'll be a good experiment to see how the public YouTube portfolio performs during a downturn. Okay, the other company, Hokage, you said that you've been adding to is ACN. That was another one that it looked really good, and I don't think I've doubled down on that company, have I? I have not doubled down on ACN yet. Let's take a look. Accenture. Okay. First question is, what is the analyst projections for forward revenue? Forecast, mixed bag on the analyst, but the consensus is buy. Revenue projection looks pretty good. They had a good earnings report, says Hokage. Also says underrated channel. Don't miss out. I appreciate it. Okay. Let's do a quick analysis on Accenture. Just a shallow dive. So with those assumptions in place, average free cash flow margin about 12. So we've got to knock a couple points off for average free cash flow margin. Yeah, so if the lowest analysts are correct, which they are showing losing revenue over the next 5 years, probably unlikely, then the stock is a little bit overvalued. But if the average analyst is correct, we've got an 17% upside on top of our 8.24% annual return that we're targeting. So yeah, and then if the highest analysts are right, so the truth is probably, it's probably somewhere in the middle here. It could be as high as 53% return on top of our 8%. So yeah, Accenture still looks really strong. And actually, let me just see something. Yeah. Last question. Which state are you from? Just curious. I'm from Texas. Texas. And Texas is hot, but it's finally starting to cool down. So the weather's been nice lately. Okay, Accenture. Quarterly report. Yeah, solid quarterly earnings report. No red flags on the Buffett supplement page. Yeah, man, Accenture is also looking as strong as ever. Not a bad one to lower your cost basis. Now, on lowering your cost basis, I do it. I double down on the companies that I have the most conviction on. Just make sure you don't, if you double down too much, you get your portfolio overweighted in one area. And it doesn't matter how much due diligence we do. Sometimes new information comes out and it doesn't pan out, So it's good to have some diversification. That's all I'm saying. I've doubled down quite a bit on Simply Good Foods. It has not panned out yet. It's down 47%. Now that's the money weighted rate of return. So it's we've put in $300 ish and it's down 97. So it's really only down about 30 something percent, but in terms of total. But yeah, this is one where, they could fall apart. They're not like they're relatively new. Crocs though, man, I got conviction with Crocs. I think Crocs is going to do it. We'll see though. We'll see. But yeah, I've got my portfolio is 6.8% Crocs now because I've doubled, tripled, and quadrupled down on Crocs. And Simply Good Foods 4.2. So yeah, so I do need to be careful not to have my portfolio get too overweight. Iridium, Simply Good Foods, ACN is just lowering cost basis. I'm going clear the ads later. Maybe I'll keep Simply Good Food 2 in stocks. Sorry, I'm not sure what you're saying. Could you say that again, Hokage, in a different way? I'm sorry, I'm not understanding. Lowering the cost basis, you're gonna clear the ads later. So like you're saying, like sell off some when it goes up, or. And then Arch Gamer says that's the one thing I struggle with myself, trying to figure out when to double down and when to jump out. Yeah, that's never an easy question. My method, the way I do it, is I perform the same analysis that I did when I bought the stock. And if the price went down, but it's still showing that it's undervalued, then usually I stay in it. You know, I just looked at Simply Good Foods, even though it's my worst holding. You know, we look at the discounted free cash flow valuation tool. It still looks solid. There's not any new information out that the analysts are reacting to. There could be something under the hood there that I just haven't seen yet, and the analysts don't know yet. And then and once it comes out, if the forward revenue projections change and the profitability changes, that's when I sell. Now, conversely, if a stock goes up a lot in value and suddenly it's way overvalued on my my valuation tool, then yeah, I would probably sell at least some of it. I would at least sell some of it. And that's tough. For me, it's the more difficult thing is knowing when to sell a winner than to sell a loser. Okay, Hokage says, I sell extra stocks when it goes above my average price. Okay, gotcha. To not cause imbalance in the portfolio. Okay, I understand. I'm with you there. Okay. So Arch Gamer. So for me, I actually have an easier time selling companies that are down, because when you sell a company that's down, you get the immediate tax benefit. So, you know, let's say I'm down, I don't know, let's say I'm down $10 and I'm in the 20% tax bracket. You know, I could sell it now and make $2 back like instantly. If the company's down and it's also now overvalued, you know, I pull the plug. I'm getting the tax benefit and I'm getting an overvalued company off my portfolio. But on the other hand, if a company is overvalued and they've made a lot of money, here's the tricky part. If I sell, even though they're overvalued, if I sell, I have to take a tax hit. So I have to be very confident that the next thing I buy has to be not only a better investment than what I was holding, but also taking into account the tax hit. So it has to do better plus my tax bracket. You know what I mean? So like if I'm in the 20% tax bracket and I sell, I'm losing 20% of my gains. So so Hokage asked about Hims. Yeah, Hims is the surprise winner. It's up $165. So if I sell it, I have to pay, let's just say 20% on 165. You know, the next stock has to make up that tax loss. So it's even more difficult for me at least, whenever I have a winner. I hope that wasn't too wordy. So let's look at Hims. Let's look at Hims really quick. I haven't looked at it in a while. I think we should look at it. And while I'm entering in all this information, I'll just yap a little bit about Hims. The way I found this company is I was using AI to help me invest. I was looking at trends in the investing space that I thought I could take advantage of. And I actually talked about it earlier with Simply Good Foods. I was looking at convenient healthcare, like kind of easy solutions, you know, to health problems. And Hims came up. They do like telehealth. They do Ozempic stuff, I think, now too. They have a lot of just convenient type healthcare. You know, it lined up with that trend. I found it by having AI pull up all the companies that it could find that kind of fit my trend criteria, and then invested in Hims, and sure enough, it popped off. So, okay, let's look at this. Let's go to Hims really quick. Yeah, it has grown a lot. Okay, forecast. So the analysts are starting to think that it's overvalued. Okay, here's the revenue growth. Revenue growth is quite high. The analysts think it's going to grow their revenue a lot. Let's enter that in. They've also been increasingly profitable. So you can see they've had negative free cash flow in 2020, 2021, 2022. They've recently made it up to positive 8.55% free cash flow. Okay. And then I think I also built in free cash flow growth going forward. Yeah, they've been trending up quite a bit. So if we assume that their profitability is going to continue to increase, So yeah, see, in this case, I would say HIMS is a little bit overvalued. We got 34% on the average analyst. They're a little bit overvalued now. And I am also using a higher discount rate than I did previously when I did this analysis on HIMS. So my criteria has also gotten a little bit more stringent. But see, yeah, here's the case though, where if I were to sell, I got to take the tax hit, and sometimes it's just not worth it to take the tax hit. Sometimes it's worth it to just to keep a stock that has the momentum. That's another thing to think about. It's like when you have a stock that's winning and then you sell it for something that's down in price, that stock, a lot of times you're selling one that has positive momentum for one that has negative momentum. And, momentum is a powerful indicator. I try not to use it, but it is a legitimate indicator. So now in this case, I'm probably having too small of a revenue growth here. Their average is like more than 10. So I'm probably undercounting them right now on years 6 through 10. Let's throw a 10 in here. That helps them out a little bit. So yeah, I would say HIMS is a bit overvalued right now. That's my opinion on HIMS. Will I sell my HIMS? I don't know. Oops, I put you on the spot to sell or not to sell. Yeah, you did put me on the spot. And it's not an easy call, man. It's not an easy call. It's a good problem to have though, when you have a winner and you're like, man, do I sell this one or not? Yeah. And maybe this is one where we trim it, we trim it down so that it's in line with the rest of the portfolio. Like you were saying, how you do your rebalance, Okaje. How about this? I think, let's see, when did we buy it? Because if we can hit 1 year, now we have a more favorable tax treatment. We have long-term capital gains. So when did we buy? Does it say? I'm pretty sure it says somewhere, but I'm just having trouble finding it. Starting value, December 31st, 2024. So how about this? Here's my answer. I'm going to trim this stock down on the new year. There's my answer. If it's still up a lot, and if I perform, the same free cash flow analysis on January 1st, right? Yeah. January 1st, 2026. If it still looks overpriced, I'm going to trim it down. If I sell, I would use the proceeds to average down on undervalued stocks. Yeah, that's not a bad idea, Hokaje. That's not a bad idea. So, Hokaje, what did you do with HIMS? Did you buy that one? Or is that one that you passed up on? I don't know if you were watching me at that time. I can't remember. But I'll tell you what, right now, HIMS is the surprise winner, but it's going to be the surprise winner in the future. It's going to be Crocs. Mark my words. People are going to eventually appreciate this company. I regret I wasn't your subscriber then. Well, that's all right, man. You missed out on this one, but we'll find more. We'll find more good ones. And you know what? ASML, it's been doing really well. Genmab, been doing really well. United Healthcare, Google, some of these will start creeping up on this range right here. But anyway, guys, that's it for me today. Thank you so much for tuning in. I really appreciate it. Hokaje, I really appreciate you coming in here and commenting and talking with me on investing. I look forward to every Wednesday, honestly. And Arch Gamer, if you're still around, I appreciate you coming out as well. Hopefully I will see you again. And yeah, until next time, y'all. Have a good week. Have a good rest of your week. And yeah, next week I'm going to be looking at next stream, Wednesday, 7:30, we're going to be looking at a company that I think will do well in the event of a bear market. We're not sure that there's going to be one, but if there is, that's what I'm going to be looking at. So, Arch Gamer, thank you very much. Hokage, good night. See you next week. Good night. Let's get more traffic here. Hey, we'll see. I hope so. But in the meantime, I appreciate both of you guys coming in and hanging out. It's been fun. So I'll see y'all next time.